Well, we're here with Dan again, of course. What's going on, Dan?
How's it going, buddy?
Oh, you know, some losses here, some losses there.
It's a lifestyle, you know?
It's weird. You'd think that, and I'm sure all 20 of you hanging out in here can relate. It seems to me like I do better on range bound days by far than trend days. It's like I can't get it through my head to just buy and ride the trend. It's I don't know, my brain doesn't accept that trends exist, I think.
I think a lot of that is kind of like built in when you first started learning about when you first started learning about like stock market and stuff like that, because you hear like buy low and sell high, and that is inherently a mean reversion kind of trading style, right?
Right.
Compared to your teacher, your book or whatever telling you, hey, buy high and then sell even higher. Um, and so I think it's really easy for someone um, who's trying to trade intraday like that to get run over on a trend day like this, right? They're less common, but they can be pretty vicious,
Right.
obviously, from the looks of it. Yeah.
And then meanwhile you have people like me who can only seem to perform well short. And days like today I'm like, hey, this looks like it's gonna fall into a short setup. Nope. Sucks to suck, buddy. Your
Yeah.
your gains from earlier are gone, my friend. Hey, thanks. Appreciate it, NQ. You're my best friend. But what we're going to do, folks, is I think we're just going to go ahead and just do a really quick refresher on what we talked about last week, and then jumping right into the continuation with Dan on his extravagant presentation. And yeah, if you have any questions, of course, drop them in the chat. I'll chime in here and there with questions of my own as well. But just like last week, this will be uploaded as a separate presentation video on the YouTube, so you don't have to dig through it and go through all of the strife and my goofy face popping up all the time. And try to keep it clean and quick. And if we have a little bit of time at the end of the hour, we'll field some Q&A and maybe do a couple of full reads, depending on what you guys are wanting. So we'll go ahead and get that going whenever you're ready, Dan.
Okay, cool. So I'll start here with yeah. So with the presentation from last week, that's shown up nice and clear, right?
Yeah, that looks beautiful.
Okay,
I was
awesome.
fighting with my buttons,
All right, all good.
but we're good to
So
go.
last week we talked about the call debit spread. And very specifically, I said last week that this week I'll explain why why the call debit spread has a lower volatility and less Vega impact. But just as a quick refresher, a call debit spread occurs when you buy a call that is close-ish or in the money, right? You buy a call and you sell a further out of the money call, and that structure is locked and stoned. For a call debit spread, it has to be selling a further out of the money call. If you reverse those, you get something called a call credit spread, and that's definitely not the same thing. So the call debit spread is bullish, just like buying a call outright. And the P&L graph of the call debit spread, once you get to expiration, has this kind of like it's very binary compared to buying a call outright, because buying a call outright has a theoretically unlimited profit, whereas call debit spread is going to have a capped profit once the price of the underlying goes above your short leg. You're in that max profit zone. And so a call debit spread is like a very much a binary bet. Like you don't need I've heard it referred to in the past as model free. Like you don't need a model to predict the value of the value of this spread as time as time goes on. It's very clear, very obvious. Once you're above that short leg, you're going to reach the max profit minus transaction fees and commission paid to your broker. And below the long leg, just like an outright call, you're looking at a max loss, and the max loss is the debit paid for the position. So there's something really simple and effective about a call debit spread. If you it takes advantage of a few different effects, but it's also very simple, and it lends itself well to light touch management, because with an outright call and that theoretically infinite profit, you need to make a management decision about when you're gonna close that position. Whereas with a call debit spread, if you are in a scenario where the underlying price has kind of rallied up and over your short leg, you don't really need to think too hard about when you want to take profit or what price level you want to close that trade out. Right, you are you're nicely in that binary zone. And then just the last thing here, a reminder that the call debit spread, when it starts off as like kind of curvy here. It's still it still has very well defined like big max profit zone and max loss zone, but it doesn't get to that like very sharp edge call debit spread profile until expiration. Okay, and so last week I said one of the pros is that a call debit spread has lower volatility with respect to price. It also has lower volatility with respect to implied volatility, and we'll talk about that as well. And that's what today's presentation is going to be out. There's less Vega impact, which is directly related to implied volatility and how implied volatility can change the value of an option contract. So unless there are any questions about the call debit spread structure and some of the items we talked about last week, I'll go ahead and go through my brief part 2 call debit spread volatility presentation. But I don't know if any questions are coming in, because all I have right now is just my my little Google slide thing. So are there any questions or anything coming up?
Nothing quite yet. People are still trickling in though. So if we get into that nitty gritty, I'm sure some will pop up.
Okay. Yeah. Awesome. All right. That sounds good. So let's go ahead and let's go through part 2, volatility specific concerns with a call debit spread. So like I mentioned in my little recap, today I want to talk about the lower volatility with respect to both price and actual implied volatility Vega impact on this structure, because that's what I said I would do last week. So you'll recall last week we were considering a JPM call debit spread where the trader, our theoretical trader, is going to buy the 205 call and sell the 210 call. And when creating this call debit spread, what I want to do in this little section right here is compare the call debit spread to buying a call outright. So first and foremost, there's obviously going to be a price difference. Buying a call debit spread is likely, it has to be less expensive than just buying the long leg, because you're selling a further out of the money option and you collect that as a credit. And so your net price winds up being the long leg minus the short leg. And like we talked about last week, the Greeks on a call debit spread are similar to the Greeks on an outright call, but they are a little bit they're a little bit muted by comparison. You're going to get more delta if you buy an outright call because there's no short leg that's subtracting deltas from the structure. And the same goes for Vega, which is what is influenced by or is what is tied to implied volatility, because you'll recall that Vega is a value associated with contract, and for every one implied volatility point, up or down, the Vega value of your contract is going to be the change in price of your contract with everything else left as is. So if you buy an outright call here, like on JPM, and initially when we opened this outright call, we had a Vega of 0.10 here, and Vega is this pink looking one here at the very bottom. So with a Vega score or with a Vega value of 0.10, if implied volatility increases by one implied volatility point, so right here it looks like it was around like 28. If implied volatility went up from 28 to 29, the value of this contract would go up by, what did we say it was, like 10? So it would go up by like $10, 10 cents. Your account would go up by $10 because options are equity options get multiplied by 100. And the discussion of implied volatility is actually kind of valuable, and I did this on purpose because it kind of lends itself really well to this discussion that we're having right here. You'll notice, so what I have in this this like kind of dark blue clip is the spot price of JPM, and then in this purple clip I have the implied volatility of the 205 call. So if you bought the 205 call here somewhere while JPM was trading at like, I don't know, maybe like 197.5 or 198, and you had this Vega value of 0.10, even though your Vega value was increasing from 0.10 to 0.12, it didn't really increase all that much. And the implied volatility during this day, during Tuesday, August 6th, was actually going down. So because implied volatility was going down, this positive Vega was actually working against your contract. Now, it's not like you lost money on this. You didn't lose money on this trade, right? Like during the day, your contract maybe traded up from $1.50 to $2.25, something like that, $2.25, or maybe back down to $2 towards the end of the day. These blue vertical lines, for the life of me, I couldn't figure out how to make this graphing program like finish each day exactly on one of these grids. I'll do some homework. Hopefully the next one it'll be a little bit easier to interpret. But these vertical blue lines are where the day, where we roll over from one day into the next. And so you could see it was great. You made money on your option, like you made a good delta trade. The underlying price went up. You bought the call. Your deltas were increasing, which is great. Thank you, Gamma, for that. And the spot price of the underlying was increasing as well. And so the value of your option had some nice appreciation during the day, right? It went up from like $1.50, and let's say maybe it closed around like $2 or $2.15, somewhere right around in this area. And we know, like, we can just visually look at this thing right here. that almost all, if not all, of that profit came from delta. Because when we look at the implied volatility and we look at Vega, even though Vega was increasing, implied volatility was going down, right? And so the fact that those two are moving against one another tells me that the P&L of this trade associated with implied volatility and Vega was small, if not zero. And the reason that that's important is, I think, best demonstrated by like thinking about earnings. Everybody, it's like a rite of passage. If you are trading some options and you buy a call or you buy a put before a binary event, and the implied volatility collapses after that binary event, the value of that option can go down very, very fast, and that can be very unpleasant, especially when you're directionally correct with your trade idea, right? And so when you're trading calls and puts directionally, if you do not have a strong view on implied volatility, sometimes you can get kind of burned by this decreasing implied volatility, and then especially as time goes on, right? You can see this last bar right here was the transition from Friday until Monday, and you can see even though implied volatility came back up, because we're implied volatility is rising because we're nearing the expiration of this monthly August $205 call for JPM. We can see our Vega value came down quite a bit. It dropped from like let's say 0.11 to almost 0.8. That's a pretty big decline, and that can definitely negatively impact our contract value as time marches on. And so I guess in terms of price volatility, which I'll speak to next, in terms of like a call debit spread Vega versus an outright call Vega, the Vega value of the call debit spread is going to be really, really small by comparison, because you're buying that long call, but you're selling a further out of the money call, and you're winding up with a net of those two, which is subtraction. And what's kind of interesting is that the net Vega on this call debit spread, as time has gone on, has gone down, but it started off really low anyway, so there just wasn't a lot of implied volatility impacting your option price in the first place, right? It's very easy to see, hey, this Vega dropped by more than half. What gives? Well, it was already really low in the first place, so any minute implied volatility impact you might have experienced on your call debit spread is approaching zero, and it's becoming more and more of like a binary kind of over under bet on the price of JPM. And so to wrap it up here, what I have graphed, and what I couldn't, I was trying so hard to figure out how to like get these two prices kind of side by side to show the shapes of the prices versus the slopes of the moves together. And I'm working on it. If anybody is familiar with like Jupyter notebooks, my Jupyter notebook is like 1,000 cells long at this point, as I was using the Unusual Whales like raw option transaction data to put these charts together. But we can see, if we took this outright call trade and we entered somewhere around like $1.50, then at the end of Monday we had a great trade, right? It's up at $3, and the range of that trade though has been pretty significant, right? We saw it more than double, um, overnight into from Tuesday into Wednesday, and then we saw it come all the way back down, almost around our entry area somewhere here around $1.50. Maybe it came down to $1.75, but it's been moving up and down quite a bit since then, and that price volatility um, can cause management headaches, right? Because you need to manage this. You need to manage this trade. You got to decide whether or not you think um, you're at a profitable place to take the trade off, or if you want to keep sort of letting it ride and hoping to experience more of that infinite upside. Now, if you look at the shape of the call debit spread, like compared to the outright call, you'll notice that they're pretty similar, right? It's like kind of sloping from the bottom left to the upper right, bottom left to upper right. There's like some up and down during the week, especially on Wednesday, right? The value of this, if we filled this trade here somewhere around like 85 cents, which is what I was talking about in the last presentation, we saw it go all the way up, almost to $2.25, which is great. That's almost like almost a 3x. And then it came all the way back down to just be maybe up by like 50% or so, and since then it's been kind of moving up, but not without some associated volatility. And where this trade becomes a little bit easier to manage is in just observing the the overall ranges of the prices are just smaller, because there's a short call on the other side of that long call, and the short call is always kind of moving in scale, in tandem with the long call. And I say that with a caveat because as you get closer to expiration, if one of these, if the long call is in the money and the short call is out of the money, then you'll notice some really interesting and potentially valuable effects, because the out of the money call will be decaying really rapidly, whereas the in the money call is also decaying, but is decaying. They're both decaying towards their intrinsic value, and the in the money call actually has intrinsic value, whereas the out of the money call does not. So it's decaying towards zero, while the in the money call, the long call, is decaying towards whatever its intrinsic value is. Maybe $1 if JPM is at 206, or $2 if it's at 207. And so you can get some interesting effects at that time as well. But the long story short on the price range of a debit spread versus the outright call is that it's just going to be smaller, right? Like this outright 205 traded from like $2 to $3.50, right? And this one and this call debit spread traded from maybe $1.60 to $2.50, and that's like 75 cents or 80 cents of less price volatility. And so this reduced price volatility can be a pro or a con, right? If you have a view on implied volatility and you think implied volatility is going to keep rising, then you would not want a call debit spread, because the call debit spread is going to mute that implied volatility, and it's going to mute some of the delta impacts of the long leg of the call. But if you don't have a strong view on implied volatility, and your assessment of the scenario tells you that it might lend itself well to a, kind of like a binary over under kind of bet, then a call debit spread is going to be really beneficial. It's going to be less volatile, and you're not going to have to manage it as tightly as you might manage an outright call where you're trying to express the same idea.
Something I wanted to point out quick as well, and this isn't necessarily related to what you were saying, but I think just kind of speaks to your spread prowess. When you were initially building this 205 210 spread, it was like a week and some change ago.
Yeah.
And since you first started part one's PowerPoint, JPM is up like 7%. And so I don't know if you were like sniping it from a point of view of I would trade this, or just sniping it for the example because it's an easy 5-point spread to teach off of, but nailed it.
Yeah, well, I mean, thank you. I'll definitely, I appreciate, I appreciate that this one was like working kind of nicely. So what was really valuable about this is like when I was assessing these and looking for an example, I was in the volatility dashboard, which I use like all the time, seriously, every single day. And what I was doing is I was in here, and I had seen that everything price wise came down, and I thought, okay, cool. With JPM at the time, the 205 strike for the monthly August expiry was the lowest point on this curve. And then the 210 was a little bit higher on this implied curve. And I thought, okay, great.
Real quick, Dan, can you full screen your... Yeah, you had something. I don't know if I should have shown on screen there.
Oh, yeah, that's fine. That was just me struggling in... That's me struggling in the program I use to make these...
right.
To make these charts right
All right,
here.
fair enough.
Yeah.
I just wanted to make sure it wasn't something bad
no,
data related.
Yeah, good eye. I appreciate you looking out. Yeah, so when constructing a call debit spread, there's generally like kind of a natural opportunity to try and buy something that has a low implied volatility, and to sell something that has a higher implied volatility. And then if you're right, what'll happen is that these strikes will kind of like slide along this curve. Right, like if we could time warp back to Tuesday, this line right here, price was somewhere at like 196 or 197, maybe 198, something like that. And you can imagine, right, that going like $7.50 or $10, something like that, was down towards the bottom of this curve. And then going a little bit further was like starting to slope back up on this curve. And that curvature is what inspired me to say, hey, this would be a good example, because it is it's like an opportune implied volatility, kind of like a smile. Sometimes you'll hear it called like a smirk, and when it's a smirk, then on one side it's just kind of flat. This is kind of flat on this other side, but it's still kind of smiley. Like it still starts to come up, and then especially as you go further out, you'll start to get more curvature on this sort of thing. But yeah, I mean, it's cool that it's very cool that it worked out, and that this like sliding down the implied volatility curve is exactly what happened. Because there are, like anything can happen, right? Like market participants can force all kinds of unique things with their interactions, and as the stock price moves around. there can be some pretty significant changes. But for the most part, having the stock price go up and having those strikes kind of slide along, like if you imagine this curve was like kind of, it's not permanent, but you imagine its like shape is pretty consistent, and so as the stock price goes up, like your strikes are going to kind of like slide along that. They're going to slide along that curve. And for the life of me, there's a book by a guy named Colin Bennett. It's like the one, it's got like the moon or the earth or something on the front. It's like very like a very hippie 3D like 3D rendering of the moon or the earth or the solar system or something like that on the front cover. And it describes these volatility regimes. There's like a sticky delta one, and then there's a sticky strike versus sticky delta. I don't remember which one is which. Which is probably telling me that I should go back and review that stuff instead of looking like a knucklehead on camera here. But this is a phenomenon that has been studied, and there are like regime names for it. I'm just an idiot, and I can't specifically remember whether that's sticky delta or sticky strike. So maybe some homework for me for next time. But yeah, I'm pleased that this, like, that it just sort of worked out in this way. And that's sort of the beauty of this. It's that's built into this structure. So as JPM price keeps kind of like rallying, right? If it gets up and over 210, there's like, if your view changes and you think, well, maybe JPM price is not going to stay above 210, well then sure, you need to manage your you need to manage this you need to manage that structure. But if your view is like 210, and 210 is like it's going above and beyond 210, then you don't really need to do anything. It's just the position is just going to grind its way towards that max profit value, and then ideally you take it off sometime before the market closes on that Friday, because you don't want to pay if you can avoid it, you don't want to pay like those exercise fees and extra costs associated with that sort of thing, right? It's probably better off to take that position off and not risk something strange happening. But your profit is very well defined, and the set of outcomes you need to consider is like very manageable compared to the infinite possibility associated with an outright call.
You might be getting a new a new Dan nickname in the near future, and I almost hesitate, but I think it's a good one. Some guy, Patrick in chat, says, "I wish this guy was my dad," and instantly my brain went to Daddy Dan.
I'll take that.
I think we're gonna have to roll with it. I'll get some. I'll get some assets made.
I'll take that. I'll tell you. Yeah, take it to the art department, right? So to sum it, to really to like put a finer point on it, if you're thinking about a call, like, especially if you're thinking about an out of the money call for like a shorter term, to express a shorter term trade idea, and especially if you do not have a view on implied volatility, like if you're not sure, you don't think you don't know, or you don't have a prediction or something like that, then it's probably worth considering a call debit spread as compared to an outright call, because this call debit spread has some conveniences just sort of built in that are natural to the structure, and that might make it a really good way to express your express your view. Not to mention that they're like less expensive too, especially in liquid, liquid options. Um, maybe you can buy a few, like if you can buy 2 call debit spreads instead of buying 1 outright call. I know that you're starting to rack up more transaction fees, commissions, exchange fees, what have you, but there's something to be said for buying 2 call debit spreads and having your trade idea work out, and selling 1 call debit spread at like plus 105 or 110%, and then because then you can sell half of the position and now the other half is risk free, so you really can say, hey, I'm not gonna overthink this, right? I got all my initial capital back. I'm no worse off now than I was a few days ago, or whenever you put the position on, and you can really just let it go instead of potentially managing it too early, or letting some other stuff kind of like cloud your initial view. And that's not to say you shouldn't update your view if things change. I mean, absolutely change your mind, change your position if the reasons for putting a position on have changed. But I think it's really easy to depending on your style, to like kind of overthink it, and to take something down before your idea might fully play out. And something like a call debit spread can work in your favor in that regard. It can like protect you from yourself in a way.
And I'd agree entirely with, even, I mean, I was going to look at it from the scope of like a small account, right? So when I personally started trading options, it was in 2018, and I think I started with like $200. And over the course of like 3 months, I got lucky a few times. One of them was on Campbell's Soup, and they got their revenge shortly after. I tried playing it again and lost all of the winnings because I didn't know risk management yet. But even after those few wins, I started on a tiny little margin account. And when I finally got to that threshold, I think it was 2,000 for that broker. Once I got there, I was afraid to play the plays I wanted to play because I didn't want to drop $100 to $500 per contract. And honestly, I think my first 2 or 3 years of options trading would have been a hell of a lot easier if I understood spreads, because then I wouldn't have that fear of buying in too much money per contract, because I would have that insurance of the shorted leg to kind of protect me from that fear. And I think it's really valuable, especially if you're just starting out, in those 500 to 2,000 range account value. Once you start getting into being able to use margin with a broker, these spreads are just so much safer than throwing money at the wall and hoping it sticks there and rides up to the ceiling.
Yeah, I mean, that's absolutely one advantage, right? If you have a small account, and buying an outright call is costs $1,000. There might be an opportunity to take a call debit spread that expresses a similar idea in a more controlled way that might only cost a few hundred dollars, right? And that might make the difference there. And so that's all I got. That's all I got prepared for this one, right? Really, all I wanted to do was just like close the loop on this, like the Vega impact, right, and show that on a real position, real time has gone past, right? How Vega started off low, right? It was started off at 0.04 compared to the outright call, where the Vega started at like 0.1. So your Vega, you have less than half of the Vega of the outright call, and it went down, and it just sort of stayed low compared to the Vega, the outright call, which moved its way above 0.12 and now has come all the way back down to like, maybe 0.085. So, the volatility differences both in price and in implied volatility impact are what I wanted to hammer home today.
Fair enough. I'm sure people enjoyed it. And yeah, I mean, obviously, I'll go ahead and get this presentation uploaded side by side with last week, so you can kind of get that full continuation one to the other if you weren't able to make it here last week. We got another, I'd say we could probably keep rolling for 15, 20 minutes, maybe a little after close, depending on what folks in the chat want. The only thing I really have that I was going to look at is I thought it was a little funny. So last week we had somebody legging into a shit ton of these Dell puts. And so I saw like the 85 put, I saw the 75 put, I saw a 90 put, and then some shorted 75 calls. And I have here on my screen, let me hide our faces so they can see the whole screen. This right here is the 85 put that I was tracking last week. And this bad boy, they opened up a good 1,300 of these back on the 6th. And Dan, I can drop this in chat to you if you want to look at it as well.
Yeah, that sounds good. I'll go take a look at it.
Or I can have your screen. It's going to be a little bad quality, so I don't mess up my latency. So let me know if that's up there.
Should I look at it in Discord, or what do you think?
Oh yeah, anywhere works. If we flip back over to your screen, I'll have you close that window and we'll be fine. But
okay, cool.
Yeah, these 85 puts, I saw them coming in on 8.6. The Unusual Whales Discord channel saw them coming in on 8.6. And the very next day, they were in profit. They entered in here on this big green bar on my screen. You can see them all coming in, all at the ask there, all 1,300 of them, right at the ask of 372. And I actually noted that they got the hell out. And I was honestly surprised by that, because sometimes we'll see these get there. Ooh, there we go.
Sorry about that.
No worries. And sometimes we'll see plays like this and they'll kind of get greedy. And that's one of the reasons I always say, just because the whale's in doesn't mean you should stay in. You got to manage your own risk. You got to pick your own profit targets. If you're up and you're like, I don't know if it'll go more or not, get the hell out. Take your profit. You made money. Who cares if it goes more? You made your money and got out. You got your bite. You got your bag in the pocket. Move on. In this case, didn't have to worry about it. These ran up the very next day to as high as, I think, 650 almost was it. Yeah, 650 was their high. And the trader appears to have exited at 5. So they still, I mean, they didn't get a massive play all the way up to that 650, but they still got a good chunk from 372 to 5. Not bad. Good trade. But I thought it was interesting because today, people are trying to run Dell up more. I saw, as we were live here, this 104 call weekly for next week. Oh, nope, 2 weeks. This is monthly. 8:30. Somebody tagged on a good 2,200 of these. Looks like 2,000 right here at the ask of 580. I'll just pop open the flow here so you can see these fills. What I'll always do, and this is just kind of like a mini lesson, what I always do when I see these interval flow come in, and you can even see here that this triggered a repeated hit descending fill, I always will check the fills at the very beginning of that interval, because I want to see if we have any shenanigans happening with the bid-ask after the fill. And I want to see if, let's say, see how this bid-ask spread, it's not crazy, 560 to 580, $20 spread there, and they're coming in right at 580. So we can be kind of confident that these are more likely than not bought to open, just because they're flat on the ask. It's not a guarantee. I want to emphasize that. There's no guarantee that they're bought to open, but it's significantly more likely. And here we can see, I scrolled all the way down. I'm not seeing any orders that came in at the bid prior. So I'm thinking, in seeing this, that yes, this is somebody longing these 104 calls. And it does appear to be the case. And so I'm actually going to heart that trade, because I want to see if we had somebody bank on the downside and then immediately turn around and rip it to the upside. But I personally, and this goes back to the risk management of things, I know a lot of people like to momentum trade. I'm somebody where if I were to play this Del Flow personally, I'm not in it. Full disclosure there, I'm not in this trade. Just a good example for what I wanted to touch on. If I were in this or wanted to be in it, I personally probably wouldn't jump on it right away. I would want to see what happens in the close today, what happens tomorrow, because Dell is already up 5.5% today. And I'm not somebody, I've been taught my lesson too many times. I'm not somebody who's going to buy the top or sell the bottom. I want to see some kind of hanging out there for a while. I want to see them maintain price for a while, maybe back test, go back up into the range. But that said, everything Dan just talked about could still be a viable option if you're somebody who does trade momentum, but you don't want that additional risk. And here we're not looking too bad. Let me check the implied volatility on this. I don't know why. Yeah, the IV is pushing up on 100%, so it's not crazy high, but it's still high-ish, where you can get some of that IV crush that I think we touched on a bit on the first lesson and a little bit here as well, Dan. As that IV comes down, the value of that contract just craters. It's crazy. And I'm somebody who's pretty risk averse, and so I don't play around with that too much. But yeah, I just wanted to point out this Dell trade. I thought it was interesting, especially after all of the bearish flow we saw last week that has since panned out. We saw the exit, and I'm curious to see how how this homie buying the top of the week does. And they got a couple weeks of time, so I mean it's not like a panic thing. But $580 per contract, a little too rich for my blood personally. We just check the chat here. I think we might have gotten a flow request or two. Corsair, Newegg, Pfizer, and Nokia. Let me refresh this. Let me see what we got going on here. Ape Daddy requests. Let's look at the Nokia one just because... Oh, it's up 3% today too, but it's also bordering that penny stock range. Not quite. I mean, it's trading at 394. Why is Nokia... Was there Nokia news? 813, Regenix AS raises Nokia 20.4 million in first tranche of Nokia 54 million private placement for Colex clinical trials. I would call that news. How long's this run up been like? Pop over to the chart. Oh my. I love these cheap stocks sometimes, Dan, because of the chart. It's just straight barcode. I don't play them personally because of the risk involved, because you see how all of this barcoding here on the chart in a measly 3-cent range, and then look how hard it broke out of that barcode. It jumped, 4% right out of the barcode and then instantly started barcoding again. I'm not somebody that's going to play with that, because if it reverses hard. Or if it continues hard. So I'm not somebody that usually buys options on usually sub $10 stocks. Sometimes I'll nab one that's around $5. But Nokia isn't one I generally will trade. Dan, I don't know if you remember or not, but wasn't Nokia part of the BlackBerry Ripper during the initial meme craze?
I feel like that was the reason I remembered NOK as the symbol, right? Normally I wouldn't be able to pull that one out, but here we are. Yeah. That is interesting. And I see what you mean about the chart, like barcode pattern that you're describing, right?
Yeah.
It seems like it just sort of picks a price during the day and then just like
hangs out.
Sits there. Yeah, right, exactly. Interesting.
Another one he brought up was Pfizer, and I actually did tweet out a Pfizer trade that I saw, and they're not, I mean, they're up a teeny bit. I just saw those 15,000 some odd contracts of the $30 call expiring on the 23rd that came in, all at the ask, average of 16. It looks like they're up about $4 now per, which, I mean, 4 times 15,000, that's still a bag of money, when when you're buying with size like that. But I did save it. I want to see how it pans out. Pfizer was up, I think, 1% and some change on the day. Yeah, it's about the same. Oh, I can actually just go check my own Twitter to see where it was trading. Where was it trading at? Yeah, they were up 1.23% when I made that tweet. And they're hanging out not too far. And I see Ape Daddy, who asked for it in the chat, also commented on the post. But yeah, that Pfizer trade interested me. They seem to be kind of bouncing off of lows. I'll actually switch to Dan's chart since he has it open already. If I could push the right button. You can see they kind of rounded out the bottom. And I'm no chart expert, of course. My charting abilities are kind of constrained to 10 to 20 minute intervals intraday. And as Dan knows, my average hold time in my scalps is very, very, very low, like sub 2 minutes sometimes. But it does look like Pfizer tried to find a base there on Dan's screen, and it's looking like it wants to bounce out of it. But if you hover up, Dan, on that looks like all the way back on the 7th where they peaked and came right back down.
Oh, yeah. Okay.
I personally wouldn't be super confident in longs from a charting aspect until they're above that and hold it as support again. Because you can still kind of see, even though they've rounded out the bottom, each time they've popped above that level, it's rejected and come back down ever since they dumped on August 2nd, it looks like. So I would want to see that flip to support before I would get gung-ho on them reclosing that range to the upside. But that's just a me thing. I'm pretty risk averse. This trader's already in profit, so maybe I'm the one that's wrong. Zero research, just here for Bidenomics. Come on. Ape Daddy, what'd you see on Corsair? I didn't see any. What is Corsair? Is that CSR? Feed SR, right? The CRSE is CRISPR, right? Corsair, they're up 1 and change today as well. They haven't had anything really since. Wow, I'm actually kind of surprised. Does nobody give a crap about Corsair, Dan? Because there is no options flow on this ticker whatsoever. None at all. The highest open interest contract on Corsair is the December 20th, 2024 contract with only 20 open interest.
Interesting. I feel like I didn't know that
I'm
this
on
was
Center
so...
Space. CRSR is Corsair. I had the ticker wrong. That is my fault. That looks a little better. That looks a little better. The highest OI is the $10 put Leap for January 2025 with 2,200 open interest. All right, I was on some random ass company I never heard of. Yeah, this makes a little more sense. I was kind of confused. I am still kind of, I guess Corsair isn't worth a lot valuation anymore. I remember this, I thought, like, and my memory's bad. But yeah, not high volume today at all. Ape Daddy says they have good earnings projections. Well, let's go to their earnings page, take a quick peek, see. Oh, they have only, so of the last 1, 2, 3, 4, 5, 6, 7, 8 earnings reports, they've only fallen within their implied move 3 times. Wow. They had their most recent earnings, looks like Q2. They had an expected move of plus or minus 9.5%, and they dumped almost 19%. So this page is actually, I'm somebody, like I said, I'm pretty risk averse. I don't usually play earnings much. I know Dan and Spreadland will punt some stuff around. But with earnings, I usually wait for the reaction to earnings rather than front run it. With the case of Corsair, it seems to pretty rarely be mispriced in the options for an implied move. And that doesn't mean options are wrong in that sense. It just means that the implied move, which is based on the implied volatility of the options contracts are pricing in a plus or minus range of expected movement on binary events, in this case earnings. And it seems most often than not, they're wrong. So there could be something to said there from the spread world too, I would imagine, right?
Yeah. Yeah, I mean, you could just buy the straddle, you know. I know it's like it's less fun. It's not as cool. There's less cool stuff going on there, but buying straddles is like the way to take, if you want to bet on an outsized move, buying the straddle is a good way to do it because you know, you don't have to worry about like out of the money, higher moment stuff taken away from your trade, right? Like you're just making a bet with the at the money strike, and buying the call and buying the put, and you're essentially saying, hey, there's going to be a more than one standard deviation move in either direction, right? So
straddles are a good
yeah.
one too. Maybe we could I am gonna just drop an article for them in the meantime, but we could probably do straddles sometime in the near future. I
Yeah.
will say that call debit spreads and straddles are about the only spreads I personally play with. So it could be a good one.
Yeah. Yeah, the put for those who are who are speculating in like the downward direction too. I know I'm just looking at I am looking at I've got Dell up on the screen right here as well, but um put debit spreads can be pretty effective too, because the implied volatility curve tends to be sloping up pretty significantly as you get further and further out of the money, and being able to sell those, right? A put debit spread is very similar to a call debit spread, except it's just it's on the put side, right? And so you're trading, you're buying a put and then selling a further out of the money put, and the implied volatility tends to really start to ramp up in that direction. You'll see, right? Because there's just a lot of interest in out of the money puts, right? It's like it's an insurance contract, and insurance contracts that pay off to the downside are very appealing to investors and people who are trying to protect a long position, right? If you're long stock, you can buy an at the money put and turn your position into a call, right? Which like limits your downside risk. So very effective tool for what it does. And put debit spread helps with that, because you can then sell a further out of the money put where implied volatility is even higher, and is very likely to be overpriced, right?
Somebody asked about the CrowdStrike options as well, and if I'm being honest, and I hate to do this because it almost seems like a dodge, but when I'm looking at today's volume, and I even looked at some of yesterday's volume on CrowdStrike, it's kind of in mixed grab bag territory, which could very well just be, residual effects of what I would call at this point the happening, the revisit of the year 2000 apocalypse with everybody's computers breaking. But I mean, a lot of this is mixed grab baggy. I'm looking through just today's top volume by chain. The 250 has the highest volume, but none of it's telling me much. We have 50-50 bid ask, 50-50 bid ask. The value of the contract did rocket, and the first bit of volume we saw this morning on the 250 call for CrowdStrike was predominantly at the ask. But the problem I have with that is that one volume bar here, a 5-minute interval, it only had about just under 500 contracts transacted in that interval. The problem with that is, yes, they were ask side, but the open interest on this contract was 5 times that. So there's every possibility in the world that ask side volume could have been a buy to close. And so it doesn't tell me, hey, this new position is bullish on CrowdStrike. It just says, hey, some volume came up. Not 100% sure what it's doing because of that open interest. And not only that, anytime I see that happening, let's say we have, in this example, we have 2,400 open interest and 4,400 volume. Technically, any transaction that happens below that 2,400 open interest, if it's not even all at once, could be a positional closure. Yes, we did break above that in volume, but we had, just as much volume as that prior to this 5-minute interval. So even that could have been an exit. And so what I'll do is I'll check the historical flow on that open interest to see how the open interest built up. And unfortunately, this is where we run into, again, how it kind of feels like a mixed grab bag. Looking through the bid-ask transactions history on the contract, every single day is a split. The only day that wasn't was back on July 25th, where it was 79% bid side. And some of that did carry over, so it does look like somebody shorted a contract or two there, but nothing substantial enough where I can make any safe assumptions with today's volume. Just because the nature that open interest built up is unclear, so the nature of today's volume was unclear. So as far as CrowdStrike goes, I'm not seeing anything that's jumping out at me as, hey, play this, if that makes sense. What are you thinking, Dan? I see you got that bad boy open too.
Yeah, like I just look at, so like at a glance here, I can see for this, since last week, the open interest is certainly on this 250 strike call. The open interest is like grinding its way up, but the volume that transacts on this contract is uh significant, and for the most part it's it's not really hanging around. At least it wasn't last week, right? You were seeing open interest changes of like 100, 100, 200, down 100, flat. You did get some trades sticking around from yesterday. So maybe that's maybe that's the start of something that's building up into the end of the week. Long call enthusiasts are certainly pleased with how that went from yesterday, where they were like trading around $1.25 to $1.50 maybe, and now they're trading over $3. But I think I'm with you. There's there's just like at least on this 250, there's not like real. We'll have to wait until tomorrow to see if these like significant large transactions seem to have stuck around, and I'm not sure if they, I might go look around and see. I like to, when I'm looking at these, I like to go look at these like big moves, not necessarily because I'm using that to determine or I'm using that to make a snap decision about direction, but I am interested to see, hey, someone put some size on, someone took some size off, right? Something significant happened whenever you catch these like step changes and put or call premium, and I like to go seek those out if I'm doing some research like that.
Now, interesting enough, on my screen here, I'm going to hide our faces again. On your screen, we could see in the net premium, and now on my screen as well, the call premium has just kind of been steady up throughout the day today. There was that one drop early this afternoon, but since then, it's kind of been trucking along, moving on up. I would argue kind of just tracing market movement today. But we see this massive drop in put premium, and it's not small. And I'm looking through the contracts here. I'm trying hard to find what did that, and here it is. I think it's these $200 puts for September 20th. Big ol' hit of 750 contracts right at the bid this morning. Now, why that's raising my eyebrow is that wouldn't have been enough to move it like this. So if you're seeing something I'm not, Dan, that would be awesome because I can't find what caused this massive drop in put premiums. What's this guy? The 242.5 put for 816? No. Starting to feel like I'm going crazy. It just has to be really expensive premium for it to drop like that. It doesn't necessarily have to be high volume. I see some call contracts that could have triggered something, but nothing like that. So maybe I am too stupid to see what I'm looking for. Yeah, that's only tens of thousands of premium, and the drop that we just saw was from net positive 1.25 million to net negative almost 2 million. And I'm racking my brain here trying to find what made that happen in the put premium. I'm going to flip my flow feed to bid only and only puts. Let's see if that does it. I'm going to put a ton of premium on there. That's a no side trade, but it is a hell of a lot of premium. No side trade shouldn't be calculating in there, though. Get rid of mid and ask. Let's see what we got on the bid. Yeah, it actually, right here, the $320 put for 816. Almost entirely bid side. That's what did it. It's one of those deep in the money, I kind of ignore it when I see it type things. Potentially arbitrage plays, potentially not, who knows. But when somebody is slinging around contracts that cost $7,000 a piece and they're, $100 in the money, I don't know if it's playable. But this does highlight that, I'm a big fan of net premium. Dan hears me talking about it all the damn time because I use the market tide every single day when I'm trading, and honestly at this point I don't trade without it. I usually trade with the out of the money only. But what I like about the net premiums on individual tickers like this is you can see pretty clearly what caused it. Like if you see net premium spike or dump, you can go check and see what caused it. Whereas with the market tide as a whole, it's a little bit harder to do that because it's tracking everything in the market. But with these, like I said, we saw this. Where'd I go? Where am I? Did I close my window? I closed my window. We see this massive drop in net premium in CrowdStrike on the puts, and instantly you guys saw, I was like, what the hell did that? And we found it. It was a trade that I personally, if I saw it in the flow, would ignore entirely. So that isn't giving me that oomph to get in a trade. Yeah. That's all I got on CrowdStrike, I guess.
Yeah, I think I would agree. There's some like spread, there are like multi-leg, there's floor volume going off. Like very, very deep in the money puts going off between the bid and the ask, like bid side ish. I don't know. It's tough to get something interesting from that, I think.
And it was part of a wonky spread.
Yeah.
I'm not a big fan of weird flow like that. And it's showing that negative 29% out of the money, those bid side puts. That's because if you were to buy a call of the same strike, it's almost 30% out of the money. And this is just kind of on the flip side of that because it's a put. So in the money would be the higher strikes. All right, I think we are rolling. If anybody has any other questions, speak now or forever hold your peace. And we'll get you guys out of here into your afternoons and evenings. I'll give them a good 5 seconds because of the delay from the stream to the YouTube. I'm used to a 3-second delay with Twitch, and YouTube has like 5 to 10, and it doesn't look adjustable except to the upside, which is not ideal. Well, all right, everybody. Thanks for kicking it with us. Thanks for the few questions that popped in. We're going to let you guys get on with the rest of your evening, and we will, of course, be back here, same time, same place, maybe. We're going to kind of play with the times, so if any of you think a different time frame would be more ideal, go ahead and I'm just going to copy paste the whole message because YouTube's fighting with me. Go ahead and comment on the tweets from today, or shoot me a DM, comment on one of Dan's tweets. Just let us know your preferred times. Maybe I'll throw a poll up later, and we'll see if we can't keep these things consistent. Pat says, love you, Dad. See you next time, Dan. Take care, everybody.
Yeah, thanks, y'all. Bye.